welcome to Steps to Investing on YouTube. Today we're talking about a really hot topic, well I think it is, and that is ethical, sustainable and thematic investing. Come to a bit more of that in detail in a second. But first of all, to introduce our guest, who is Amelia Sexton, who works for Holden Partners. Amelia, welcome to the show.
Hi.
Perhaps if you could just tell us a bit about what Holden Partners do and your role there.
Yes, so I'm an investment manager at Holden Partners, and we are a financial planning and investment advice firm. So we provide financial planning advice and investment management services to private clients and also some charities as well. And what really sets us apart on the investment management side is that we have an alternative investment process that we call ethical, sustainable and thematic, or EST.
Let's call
investment.
it EST.
EST investment.
And what does EST investment entail? What's it involve from your perspective?
So it's really an investment process that's trying to generate long-term sustainable returns, mitigate risk and generate a positive impact if possible. And the way that we do that is that we don't just look at financial data when we're making investment decisions. We're also looking at a range of other metrics, including environmental, social and governance factors, ESG, and global trends that are going on in the economy. And we really feel that by doing that, we can tap into some of the opportunities that are presented and also mitigate some of the risks that we might face.
Okay, so if I was thinking about trying to invest in an EST fashion, what would I be looking for?
So you'd be looking for a long-term view, firstly, which is the most important thing. And typically, investment practitioners are kind of focused on the short term, thinking about quarterly, if not yearly performance. The problem with that is that the industries or the sectors that have performed well over those periods might not be those that perform best in future. So to mitigate that, we're really taking a long-term view. What's going to be driving change over the next 5 to 10 years and how can we capitalise upon that, essentially?
So for example, I don't know, something like technology must be a huge theme within that space. It's changing our lives on a daily basis.
Yeah, absolutely. So an acknowledgement of what themes are driving global change and what trends we can tap into through investment is a really key part of that. Like you say, technology is one, resource efficiency is another, clean tech is another that taps into climate change. And then you've got social themes, things like healthcare, which helps tackle an ageing and growing population. So there are many structural themes that we can target through this process, and we believe that really gives investors exposure to long-term sustainable growth.
So a portfolio in that sense will be a wide variety of those things. It's not just targeting necessarily one distinct thing.
Yeah, perhaps not. Some portfolios may use a thematic investment philosophy where they target a range of certain themes and pick up on the best ideas within those themes that perhaps would provide the best potential return over the next few years. Others will focus on a specific theme. Others might not necessarily focus on themes at all. That may just be a function of their stock selection. So they may find stocks that are taking advantages of some kind of solution to a sustainability issue, and they may fall into a certain theme and they may build up exposure to themes in that way, but they're not necessarily targeting certain themes.
It's not the other way around. It's not looking for things in a theme. It's looking for stocks, and they just happen to be in a theme. And are you then, just to be clear, are you buying individual companies, or are you buying other funds?
Typically, we're buying funds that will invest in individual companies within these areas. So when we're buying funds, it might be that we buy what we call a thematic fund, which follows the process we've outlined, where it targets certain themes and tries to pick the best companies within those themes. It may be that they're taking a more general sustainability view, in that they're just thinking about viability of a business over the long term, and that may be to do with the product it's providing or the way it's run, whether the management is taking consideration of environmental and social and governance factors. Or it may be something that's more traditionally ethical, whereby you're screening out what you deem to be negative sectors, perhaps which are slightly controversial, and operate in areas where there's sort of public negative sentiment on them, or perhaps regulatory barriers, things like tobacco or armaments or animal testing. So there's a variety of ways that you can access sustainable investment. But really it's just about not focusing on financials and realising that there are other things that can contribute to opportunity and risk.
You're looking at fund managers' ability to pick those companies.
Absolutely, yeah. I mean, there are some opportunities now within the passive space in sustainable investment. It is quite a nuanced subject though. So
it sounds really complicated.
Yeah, so typically passive trackers that are tracking some kind of sustainability index, they will rely on what we call ESG scoring. So they will rank a company on a range of metrics and boil that down to one number, which they essentially will use to rank how much or little of a company to include in an index. That's obviously quite simplistic, and it doesn't necessarily pick up the nuances that are sometimes required when looking at a company in a sustainable way. So there's work to be done there. There's also a few biases in the data whereby perhaps if a company just provides more information on what it's doing in its environmental and social activities, it will get a higher score. So it's not without fault. There are some issues within active management as well, where investment houses launch funds that are called impact or sustainable, and they may not necessarily be following a really stringent and comprehensive sustainability process. So we have to be careful, but really it's something that lends itself to active management because of the way that certain factors are more material to some companies than they are to others. If a company is operating in the oil sector, some of the environmental barriers that company will face will be far more important than the social side.
You said at the beginning of the show this is something that's a hot topic. Mm-hmm. Why is that? Why is this becoming more in people's consciousness when they're investing?
I think because there have been a few high-profile cases where issues around environmental management or governance have impacted a company's share price quite substantially. Mm-hmm. So we saw it with Volkswagen a few years ago. And the issue there from a sustainable investment perspective, if you were using a passive approach, you would have included Volkswagen in your portfolio because it was actually ranked quite highly by a lot of the sustainability indices. And that was due to its apparent commitment to sustainability through its environmental policies and the product that it was developing. It turns out that actually its corporate governance was quite poor and the product it was developing was actually flawed. So because of those high profile cases where other things, not just traditional financial performance around revenues and profits, have really impacted a company, I think it's a more widely accepted issue in the public consciousness now.
And presumably then what you're saying is, I may have got this wrong, but what you're saying is that the process of thinking about investing through an EST lens might help to spot some of those future Volkswagens or BPs or whatever.
Absolutely. I mean, we find that thinking about the way that a business tackles ESG and thinks about issues in that areas can give a real insight into the quality of the company. So the culture, the risk profile that you're likely to get from that investment, and really the likelihood of something occurring that might be truly detrimental to that business and that might not be able to be picked up just from looking at financial statements. So it really is a risk mitigation tool as well as something that we use to identify opportunities.
Let's talk about diversity, because when people are thinking about the structure of companies and who runs them, isn't something that's often on people's mind. How do you consider diversity? Is it just about gender?
No, definitely not. I mean, diversity of any kind is beneficial for an investment process because it encourages independent thought, it encourages ideas to be scrutinised because people will have different viewpoints. Gender is one part of that, and it's great to see that that is now something that's being tackled within the investment management industry. However, age, education and background, social standing and class, race, they're all other features of diversity that we should also be looking at, not just gender. And that diversity is really important for us when we're looking at a fund management team. We want to see a team-based approach ideally, and even if there is a lead manager, we don't really want one person calling all the shots. We want a flat structure where it encourages sharing of ideas because we find that seems to identify the best opportunities.
And when you're considering sustainable EST type investments, do you find there's plenty of choice? Is there a lot out there to choose from, or are you struggling to?
No, absolutely. There's definitely more choice available now than there was a few years ago, which is a good thing and symbolises now that there's wider recognition that thinking about these other factors, not just financials, can really be beneficial to performance. Investors just need to make sure that the aims and the methods that a fund is using to generate returns are really aligned and are as you would expect for a sustainable investment fund.
What do you see in the future? How is this going to develop?
I think it will continue to gain traction, because I think the outdated view that you can't combine sustainability principles and good financial performance is now, outdated, and it's been proved incorrect. But like I said, there's work to be done on how we communicate to investors the different nuances of sustainable investment, whether it's ethical, whether it's sustainable, thematic, whether it's impact. And a lot needs to be done there, because I think some of the jargon has kind of clouded the public perception of what these products are actually aiming to do. So as long as we can work on that and get, some agreed definitions, some agreed methodology and measurement criteria in place, then I think the industry will continue to grow.
Finally, to sum up, what would your top tips be for somebody who is thinking about investing?
Take a long-term view. Think about what could be driving change in 5-10 years, not just in the next quarter or the next year. Think about the risks that could be presented in that time, whether they could be linked to the environment or social issues, and how they're being tackled through the investment that you're buying. And think about structural themes. So think about resource efficiency, climate change, demographic shifts, and how you can tap into those opportunities, because they're areas where you're really likely to generate a long-term sustainable return.
That's super. Thank you very much for coming on the show.
Thank you.
Well, that's all we have time for. It's been a fascinating topic. If there are other topics that you'd like to see us address in future shows, then just leave them in the comments box below. But for now, that's all. Thank you very much for watching. Goodbye.